Hey everybody, Marty Missouri here, Friday the 7th of June 2024 with a quick economic roundup for you for the week and a quick look at key markets and some key market indicators. So our PWA index actually rose 4 points, so we made back the 4 points that we gave back the prior week. Still negative 26 points, still suggesting that recession odds are too high to ignore right here, despite the fact that I think to this point this year, much of the market has been ignoring the odds of recession. Today's jobs numbers were exceptional when we look at the establishment survey, but when we look under the hood, we want to get into the weeds a little bit and look at some of the detail that may not be quite so rosy and actually jibes, if you will, with our go-forward economic outlook. So with that, let's go ahead and jump right into the employment figures. So the establishment survey. So this is a survey of businesses. 272, the consensus estimate among economists was 180. And the whisper number, if you will, on Wall Street, kind of like earnings, there's kind of what the market is expected, and somehow they are able to glean this from conversations or surveys, I guess. Was actually 160, and that's the first time the whisper number has actually been lower than the economist's number of 180 this time since last November. But like last November, they were wrong, and the actual jobs number was significantly higher. Unemployment rose up a tick. By the way, the unemployment number comes from the household survey, and I want to talk about that as well. Average hourly earnings ticked up a little bit. Quits rate was flat. Job openings dropped by like 700,000 or 800,000 this last month, so that's interesting. The labor force participation rate came down a little bit to 62.5. The U6, which captures part-time workers and discouraged workers, unemployment rate 7.4. The household survey, so folks, this is the one where they actually call households and ask them about jobs, in the house, who's lost their job and so forth. A whopping 408,000 decline in jobs. So 400,000 jobs lost if you listen to the household survey versus 272,000 gained via the establishment survey. Last month, by the way, it was 25,000 gained in the household survey. So depending on who you talk to, I actually listened to a panel of analysts this morning, and two of them actually started right out with it's really the household survey that's much more important. Another one, a credit market analyst, said absolutely not. The household survey is too noisy. It's the establishment survey that counts. One thing about the establishment survey, by the way, folks, is that, of course, they're only going to interview companies that are still in business. So companies that are no longer in business, there's going to be job losses there. And, of course, those don't get counted. So it'll be interesting to see. One thing's for sure, and always keep this in mind, these monthly employment numbers are lagging indicators. They tell you what happened last month. It's the leading employment indicators that are under the surface that we want to pay close attention to. And those are actually pointing to a weaker labor market, which is, on balance, more consistent with our 6 to 12 month economic outlook. But the market reaction today was really fascinating, and I'll get into that here in a minute. The Institute for Supply Management survey, both the manufacturing and the services sector surveys came out this week. Manufacturing dipped further into contraction zone. That's the white line. So that's showing contraction or recessionary conditions, if you will, in manufacturing. And then services, which dipped down into the contraction zone last month, shot straight up to 53.3. So I'll just share with you the paragraph I put the next day into our market log. While the ISM Services Index for May moved back into expansion territory, which, if good news is bad news, should have roiled stocks, yesterday's rally, I suspect, was to some extent inspired by the fact that the prices paid component slowed and the employment component continued to contract. The Fed has made it abundantly clear that they will not hesitate to cut rates if they start seeing weakness on the labor front. So up until today, which was a really good jobs number, if you just look at the establishment survey, the market had been rallying on anything that kind of smelled of weaker employment data. So as I speak, stocks are flat. the Dow's flat, the S&P is flat, the NASDAQ is flat, the equal weight is down a little bit. The breadth is terrible, right? So we have financials up 79 basis points, which is interesting. We have healthcare and tech are the three sectors that are up. And by the way, healthcare right now is our largest sector weighting in our core allocation. But commodities are getting absolutely slammed. Gold is down 3% as I speak. I know copper's off a bunch, ag commodities are off a bunch, and the dollar is soaring higher. So we've got extreme mixed messages from the markets. And in fact, rather than rambling, let me just quickly paraphrase my log entry this morning when all this data came out. Today's employment report for May was a real head scratcher. For the first time in a while, Wall Street's whisper number was actually lower than the economists' estimates. And lo and behold, the establishment number blew the doors off to the upside. The household survey, however, couldn't have been more the opposite. Establishment up 272,000, household survey minus 408,000, full-time minus 625,000, part-time plus 286,000. And from what I read from another economist's explanation of this morning, I don't have it in front of me, was that the vast majority of the job losses, if not all of them, were in like the 20-something demographic. And to me, I guess that speaks to maybe, that services sector that's been so robust is beginning to let loose of a lot of jobs. But of course, we'll see. It's all of this is very, very noisy. Back to the market reaction, though. I actually think stocks are kind of getting it right? Stocks are up a little bit, but again, sector by sector, I got to be careful with that because again, the breadth is terrible. But the major averages are up. The fact that healthcare's up makes some sense to me. Can't really speak to financials being up so much. That seems to be that people are buying the higher interest rate narrative if they're buying financials today. Gold and long-term bonds, I think, are getting it wrong. Up until recently, there had been some buying in those areas. I think people have been maybe beginning to adopt the recession narrative as the data have begun to weaken, and they wanted to get in front of it and own gold and own long-term bonds. And of course, there's been a lot of international buying of gold, which we've talked about. And then today's headline jobs number probably freaked them out a little bit. Probably a buying opportunity. We have plenty, so we're not buying anymore. Precious metals right here. If we were too light, I might take this as an opportunity to pick some up. But again, this is going to be very, very noisy. Our gold position now is really a long-term view, although we do think it'll do relatively well, maybe substantially so, in a recessionary environment, say over the next 6 to 12 months. As for today, it's really hitting holders of gold noticeably. Down 3% is a big one-day move. So in a portfolio like ours, which is broadly diversified, I mentioned that we have healthcare, but when you take that big a hit, we're going to have a really poor day relative to the equity markets. And again, that's not our benchmark. We're a global macro all asset class investor, but people look at stocks. Yesterday, for example, it was the opposite. We notably outperformed the stock market. And so that happens when you're broadly diversified, and I think you have to be right here. I will, though, remind clients that we have had our industrial commodities exposure on watch. We cut a little bit, several months ago, and as of today, we're going to cut our industrial miners exposure back by about a fourth. So we're cutting it a little bit more, picking up a little more healthcare, a little more consumer staples, and we're picking up exposure to natural gas via the one stock position that we have to express that view. We think the potential for natural gas to the upside is not small this year coming off of these levels, so we want to be exposed there. Just to kind of give you that narrative, natural gas is down like 25 to 30% on the year. Our position is actually up 19% on the year. Now, part of that is via share buybacks and increasing of a dividend, but it's also, I think, the market's anticipation that nat gas has maybe nowhere to go but up. I don't want to exaggerate that, but looks pretty compelling to us right here. But in a world where there's a lot of uncertainty, nothing's guaranteed, so we're trying to be careful and thoughtful with every single one of our positions. So anyway, mixed signals galore. Okay, so global PMI is still going up to 53.7. Now, I've been talking about the disconnect between places like Europe and the economic data and the US, and that's reflected here. But I've also said that I'm not as sanguine as others right here, that if the US were to suffer a recession, that the rest of the world just goes chugging right along, particularly with issues that I think are largely unresolved still for China. So we want to be careful with that. We have done some rotation that's worked for us nicely, except for today. European stocks are taking a pretty good hit today as well on a rising dollar. But again, globally diversified and asset class diversified is absolutely key right here. So I've been talking about commodities. I've been pointing to weakness in the charts in commodities. The Bloomberg Commodity Index, we said, was really, really toppy up here. You can see from a technical perspective, it's beginning to wane. And like I said, as I speak, we're cutting some of our industrial commodities exposure. Now, I do want to say here that if you look at the opposite move in the CRB Raw Industrials Index, which captures industrial commodities that are not traded in the futures market. So this one is going to be a reflection of what traders are doing, and of course fundamentals. This one's just going to be purely fundamentals. So, are traders anticipating something? That's essentially what I'm suggesting that we are, and so we'll see. This of course is not good news on the inflationary front. This would be. Speaking of not good news on the inflationary front, this is the Shanghai to LA price of a 40-foot container. And you can see that is not a good look if you're worried about inflation and you want the Fed to cut. Here is the overall index, the WCI container index, and you can see what that's doing as well. Interesting dynamics, again, mixed signals galore. In terms of sectors, if you look at the last month, the only thing that's been working virtually has been tech. So this 102 means that tech is outperforming the S&P by 2%. But if you look at financials, discretionary stocks, materials, energy, industrials, even staples, utilities, and healthcare, all of them have underperformed the S&P. That is not the kind of breadth that's consistent with a healthy bull market. Okay, so with that, we'll just stop on the economic stuff and get just quickly today through the technicals. This is the weekly chart that I showed you last time that looks very concerning to me with your upward sloping wedge and your bearish divergence. Nothing has changed over the course of this week. On the 1-year daily, we've had, I would say 2 failures in a row here on these bear flag patterns. That looked like a pretty good bear flag there as well. And you can see the S&P breaking through that. So now we have kind of an extension, call it a rising wedge pattern. And this popped to a marginal new high. We have quite the bearish divergences, notwithstanding the buy signal here on the MACD. I like the term heavy right here. That's how this market looks to me. On the NASDAQ 100, essentially the same picture, right? You've got, just right here, marginal new high, and you're not really confirming that. And you're almost in overbought territory again here on the RSI. So again, not the kind of look that you really want to back up the truck and start buying stocks on. Breadth is absolutely abysmal again. This is the S&P equal weight. This basically takes all of the S&P 500 stocks and gives them equal weighting. And here's the index going to new all-time highs. Not the kind of setup that makes me feel warm and fuzzy right here, I'll tell you. Another breadth indicator that's been a really good one, worked for us pretty consistently, has been the S&P versus the percentage of stocks that are trading above its 50-day moving average. So here we are at all-time records, and barely half of the companies in the S&P are trading above the 50-day moving average, and you can see what tends to happen when we get these bearish divergences. It works in both directions. Here we were bullish, right? Rightfully so, rightfully so. And there's more, but I'll stop with the advanced decline line. So here's the S&P 500, again, hitting all-time highs right here, and advancers versus decliners, meaning more decliners than advancers, going in the wrong direction. Long term, this has been very helpful to us to gauge go-forward direction in stocks. So the yield is spiking big time today. So bonds are responding to the headline jobs number. We'll see ultimately how that plays out next week. Will be interesting, of course. I've been showing you this negative correlation between the dollar, bonds, and stocks. And thinking of the dollar, there's the dollar just shooting to the moon here on that data. So this is people who are probably short the dollar, perhaps long bonds and short yields, getting caught on the wrong side of that jobs number. That was a real surprise. But again, I just can't quit thinking about the household survey. And then gold taking a pretty good hit here. Now, I've been telling you about our concerns about how the technicals look. Fundamentally, we think gold looks really good on a longer term time horizon, but here it is today, breaking and gapping down below its 50-day moving average. Obviously, precious metals people who've been buying in here and buying here got spooked today by today's jobs number. Again, our best guess is that this time around it may be the household survey that's more telling. If that plays out that way, then gold should be okay right here, but of course we'll keep an eye on it. So folks, again, I could ramble further, but I think I'll stop there. All I can say to you is a very mixed picture. What we're doing here at PWA is staying very diversified. We are hedging our equity exposure here and there, hedging some of our commodities exposures as well, cutting commodities a bit in the industrial space, adding to more of the defensive issues, staying pretty liquid with more than 20% in short-term treasuries right now. And that's how we're going to do it as long as conditions dictate that we do it that way, and while we continue to tweak around the edges. So folks, I'm going to be gone on vacation next week, so probably won't get anything from me. No written commentary and no end of week economic commentary. After the fact, I will score our index for next week, but I'll probably just pick up the following week with the written blog, and then that following weekend with the economic commentary. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend, and I'll talk to you next time. Bye-bye.